Okay, well, it's 8 o'clock, so we'll go ahead and call our meeting to order. Our first order of business is to consider the minutes of our November 17th, 2021 meeting. Are there any comments or changes?
If not, I'll move to approve. Second.
Okay, all those in favor?
Aye.
Any opposed? Okay, our next order of business is to elect a vice chair for the committee. After last meeting's debacle, I would like to go ahead and get that in place. I cannot make a motion, but I would like to recommend Melissa Wright if she's willing to serve as vice chair. As y'all know, Melissa has served on the committee for a number of years and is still considered an active participant as she runs out her time on her extended vacation. So if the committee would like to consider that.
I would move to have Melissa be vice chair.
Okay.
Second.
Okay. All those in favor?
Aye.
Aye. Any opposed?
I'll abstain.
Okay. Okay, so next we have Natalka on the line with Chartwell to discuss and review our fourth quarter and January and February of 22 plan performance, flash reports, asset allocation, and rebalancing recommendations. Natalka, thank you for joining us.
Well, thank you, and thank you for letting me participate by conference call for this meeting. I wish I could be there, but I'll make the next one. I was going to start off with a brief review of the fourth quarter and year-to-date performance through 2021. I know that it seems like a long time ago, and a lot's happened in the last 2.5 months, markets and geopolitically. I do want to just sort of touch on a couple of things for 2021 for the plan, and it also sets us up for the discussion for January and February of this year, because some of the trends that were occurring are continuing in January and February from a market standpoint. So if I could ask everyone to go to the Chartwell fourth quarter performance summary report. In the materials that Lita sent out, it's section 3, and it's page 5 of the Chartwell fourth quarter performance report is where I'd like to start. So on page 5, we're looking at equity market returns through year-end 2021. I'd like people to sort of focus on the 1-year column, which is in the middle of that table, because as you might recall, 2021 was a very strong year for equity markets, led by domestic equity markets, and it was a negative year for fixed income. Within the equity markets, in that middle, on this table, showing the performance of the asset classes within domestic equity, large cap, mid cap, and small cap, and then across the top, the value, the core or the blend style, or growth. And just a couple of things that I'll point out here is that the darker the green on the box means the strongest returns, and the lighter the green are the weaker returns. So the best performing asset class within domestic equities in 2021 was small cap value, with a return of 28.3% for the year, and followed closely by large cap growth, 27.6%. Small cap value rallied very strong in the first 6 to 8 months of 2020, and then sort of just, I would say, hung on through year end. And the growth style, which took a beating in the first half of 2021, rallied, particularly large cap, in the last quarter of the year. Small cap growth, 2.8%, was the weakest performing segment of the U.S. equity markets in 2021. So there are not that many years where between small value and small growth that you see a 26% difference, delta, in the performance of those two indices. So value certainly staged a comeback during the reopening trade of COVID. Large cap growth stocks struggled at the beginning of the year but came on strong at the end. And the mid and the small cap growth were the weakest performing segments of the market. And those trends have pretty much continued through January and February. Where small growth and even large growth is pulling back further than value, and value containing a lot of defensive sectors like energy, like utilities, like consumer staples, is holding up better during this pullback. If we drop on that page to lower boxes, you'll see the international indices, and in the last row you sort of see international large cap. That's sort of the MSCI All Country World ex-US index was up 12.6% in 2021. And then to the far right, see emerging markets in the pink box. They actually finished last year in negative territory, down 0.5%. And so international developed markets did well last year, and emerging markets struggled last year.
Tonka?
Yes.
Could I ask you to do a brief comparison of a small cap value versus a small cap growth? Why is there such a difference in those two stocks?
In those two categories, in the small cap growth indexes, you have a lot of small technology companies, and you also have within the healthcare sector more biotech rather than like large pharmaceutical companies, and those sectors have not performed well. Whereas in the value, the small value index, the largest component of the small value index is actually the financial and real estate sectors. Those two combined in the small value index are about 35, close to 40% of the index. They did well last year. There was a lot of consolidation in small cap financial companies, small banks going through mergers and acquisitions. And also within small value, the energy sector is a much larger component than it is in small growth. And energy staged a comeback last year.
Thanks.
No problem. I do not have a similar chart to this for the bond markets. What I will say in summary in the bond markets in 2021 was it was a negative year of performance for core bonds and most bond market segments. The only categories that finished in positive territory in 2021 were high-yield bonds, floating rate banknotes, and TIPS, both intermediate and long-term Treasury inflation-protected securities. All other segments finished in negative territory. So, and that, unfortunately, even that trend is carrying through January and February. Our fixed income markets year to date are lower or more negative than they were for the full year in 2021. And a large part of that was the fact that we're trying to price in the impact of the Federal Reserve Bank's change in interest rate regime. And in fact, today we're probably going to see a 25 basis point increase in Fed funds rates. And the bond markets from the 2-year to the 10-year are trying to price in, are we going to have 5, 6, or 7 rate increases? You know, were they going to start with 50 basis points? Were they going to start with 25 basis points? So the bond market's been grappling with that, and they were grappling with the fact that inflation is stubbornly high. Looks like it's going to be sticking around for a while longer. A lot of people still feel that inflation may moderate in the second half of this year, but certainly the last 3 or 4 months of inflation reads have been less comfortable for the market than anticipated. And then, at the end of February, we had Russia's invasion of Ukraine to sort of throw another, if you will, hurdle into the economic and financial market uncertainty. So both bond markets and stock markets have started off this year in negative territory. So do want to just sort of very quick performance. If you go to page 6 of your plan for the year of 2021, and then we'll update it, of course, as we go through January and February. 2021 was a strong year for the plan. Again, I'm going to focus in on the year-to-date column for the sake of sort of brevity, but also just sort of incorporating all of the performance and trends that occurred. But your total plan grew in assets from $161.6 million to $184.2 at the year end. And in the upper left-hand column, you can see that your investment gains during 2021 were $24.2 million, and the plan experienced $1.6 million of net outflows, benefit payments, and other plan expenses throughout the year. The plan, from a performance standpoint, performed quite well. For the year, you were up 15.1%. It did lag the blended target index by 0.4%, but still a very strong relative number. And it placed well in a universe of similarly balanced funds. Below the total plan composite, you see your 4 investment teams: global fixed income, domestic equity, international equity, and real assets. Your global fixed income team, I know that a 0.6 return for a year in bonds does not look or sound very exciting, but it was a negative year for fixed income. So the fact that the team posted a positive return was a win. And you can see the blended target index was about 1.8% lower than the 0.6 at minus 0.8. Your domestic equity team also lagged slightly, but posted a very solid 23.2% return for the year, so 1% below the index. And when we'll take a quick look at your equity managers, and one of the things that we'll see is that Pinnacle Equity, while posting a very strong year of performance, did lag the index, their S&P 500 index benchmark, and they're the largest equity manager that you have, and so they sort of held back returns a little bit. The international equity team was the weakest team last year for your plan. They rose only 5.6% versus 8.1%. You have two global global equity managers, one international and one emerging markets manager, and the Dodge & Cox International stock fund topped index in 2021. The two global equity and emerging market manager lagged, and we'll take a look at that in a moment as well. The winning team, if you will, for the year was your real assets team, and this is where your commodities natural resources fund is housed, as well as global REITs and two domestic REIT managers. And they had both of those asset classes were top performers in 2021, and your team topped the index at 35.8% versus 32.8%. So strong year of performance from real assets. If you want to turn ahead to page 17 of this report, we can take a quick look at fixed income team and the equity team and international and real assets, just so you have a feel for how the individual managers did. So on page 17, we have your bond management team, and you can see that Pinnacle Fixed Income and TCW Total Return, those are your two core bond managers. Pinnacle focuses in on corporate bonds. TCW focuses in more on mortgage-backed and asset-backed securities. Both of them finished in negative territory, in line with their index, down 1.1 to 1.5%. And your high yield manager and the Western Credit Opportunities Fund both topped their indices, and they were invested in the right places in the fixed income market. They're the more volatile. They're the less comfortable areas because you're looking at high yield and floating rate notes and CLOs in the case of Western Credit Opportunity and such. But both of those managers did very well for you and pulled that composite into slight positive territory for the year, as we saw earlier. And if we go to page 18, if there are no questions on fixed income, we can take a quick look at the domestic equity team. And again, focusing in on the year-to-date column of performance. We start off with Pinnacle, your large cap core manager, up a solid 26.2% for the year, but that did lag the S&P 500 by 2.5%. Brandywine, did somebody have a question?
No.
Okay. Brandywine Dynamic Large Cap Value, as the name states, is your large cap value manager. Large value was a strong performing asset class last year, up 25.2%, and Brandywine topped that with a 29.3% return. So Brandywine has been doing pretty well for you. since their inception in 2015, and since 2015, value has not been a style that's been in favor. So they've been sort of fighting a bit of a headwind, but they've been posting pretty competitive returns with even Pinnacle's core strategy. And certainly now, value, we're seeing a resurgence, and when I give you a little bit of a performance update through February, large value is holding up much better than core and large growth. You have two mid-cap managers. Harbor Mid-Cap Value was your top performing domestic equity manager for the year. They rose 30% versus 28.3. Janus Enterprises Mid-Cap Growth. They also topped their index by 5%. But the mid-cap growth space was more challenged than mid-cap value. And then you have two small-cap managers. Vanguard Small-Cap Growth is an index or an ETF. They did top Small Cap Growth Index, which was the weakest segment of the market, posting 5.6% return. And then you, as of December 2nd, you had a change in your Small Cap Value Manager from Cerdex Small Cap Value over to American Century Small Cap Value. And Cerdex finished off the quarter strong for you, and American Century started off their tenure with you as a small cap value manager strong. So, that was good to see. And just as a side note on American Small Cap Value, they closed the fund to new investments at the end of February. So I'm happy that we were able to get in when we did.
Yeah.
Any questions on domestic before I move on to international equity?
I don't see any.
Okay, international equities on page 19, your team. The two global managers that you have are American Funds Capital World Growth and Income and Janus Global Research. The difference between those two managers is Janus Global Research does not invest in emerging markets. They invest only in developed markets. American Funds Capital World Growth and Income invests in both developed as well as emerging markets, and of course both invest in the United States because they're global equity funds. And both of them had solid performance in absolute terms, up 15.1% and 18%, but both lagged their respective target indices. And then Dodge & Cox has staged a nice rebound. They had some performance problems over the last 3 years. They've been on performance watch lists, but very strong performance for 2021, up 11% versus 7.8% for the All-Country World ex-US Index. And Invesco Oppenheimer Developing Markets lost more than the index. They have more exposure to both China and Russia, and that particularly the Chinese exposure hurt last year, and the Russia exposure is hurting a little bit more this year. And so I think that now's sort of also a good time to potentially update the committee on what exposure you have to Russia in the portfolio. I included this with the February monthly flash report write-up, but you have 4 managers that have exposure to Russia. Dodge & Cox International stock has 0.54% exposure, so 0.5%. Janus Global Research has none. American Funds Capital World Growth and Income has 1.5% exposure, and Invesco Oppenheimer Developing Markets has 4%, and 2% to 2.5% of that is in two stocks, Yanadex and Novatech. So your exposure is minimal. None of your bond managers have exposure to Russia. You don't have any international or emerging market bond managers in the portfolio. Russia at the end of February was eliminated by MSCI from their indices because it's the Russian stock market is closed, so it is an uninvestable stock market at this point in time. So MSCI as well as FTSE Russell eliminated Russia from the index. At the time of its elimination from the index, it was 1.5% of the emerging markets index. So you're going to see in the emerging market index a bit of a blip with Russia being removed, but I think not nearly as big a blip as some people might have anticipated, because Russia's presence in the index since 2008, they were a 10% exposure in the emerging market index, and by the beginning of this year that had fallen to 4%, and by the date of their elimination it had dropped to 1.5%. So their role in the emerging market index, stock market index, has been diminishing over time. And that's not to say that active emerging markets managers like Invesco Oppenheimer, they have the option of overweighting countries, as any active manager does, and so they were sort of in line with the index weighting through year end at 4%, but they did not. I don't know of any really active emerging market managers that were selling out their Russia exposure before the invasion.
Okay.
So, Natalka, it's Greg. Are the sanctions that are in place? Are these? I guess that's going to impact these funds that, or the stocks that these funds hold.
Yeah, so currently, for instance, I've been on the phone a lot, particularly with Invesco. They've been having almost, weekly calls as things developed. And so Invesco now has set the value of the 4 holdings that they have in Russia to zero.
They've written it off completely. Okay.
They've written it off. They can't sell the holdings, but for purposes of performance calculations and valuing the fund, currently they've written it off. If those, when Russian markets reopen and trading begins once again in those securities, it could be that, they get a recovery value. But for right now, they felt the prudent thing to do from a full transparency standpoint was to write it off completely. And I'm sure that other Dodge & Cox is probably also valuing, its holding is in Magnit, and that's a Russian retail a company. I'm sure they're writing it down to zero as well. So it's sort of been evolving on a weekly basis as markets have closed, as things have been taken out of the index, and funds are figuring out how they should, appropriately, assess their holdings.
Thanks.
On page 20 of the report, we'll finish off with just a look at the real estate and your real asset managers. The Global REIT manager, Prudential Global REIT, was up 27.9% for the year, trailed their index a little bit, but very solid performance. Their Natural Resources Fund, it's an index fund, an ETF, matched the 39% increase of the S&P North America Natural Resources Index. And then you have two domestic REIT funds that came on board in July of 2020. So almost, 18 months into their tenure. Both of them had very strong performance year to date. In 2021, Cohen and Steers was up 43%, and Principal was up 39.7%. Natural Resources continues to do well in January and February. Last week, oil, both WTI and Brent, were above $120 a barrel. Rose to that on the geopolitical concerns of Russia's oil and gas supply and what it would be going forward and at what cost. We're now back down on WTI below 100. It always has been a very volatile asset class. I think it will continue to be. I'm glad that last year you had exposure there. I'm still glad that you have exposure there. I think the exposure is pretty right-sized at this point. And your global REIT managers, so REITs are real estate equities. So the REITs have not escaped the wrath of the market pullback in equities. So they have lost some ground pretty much in line with what the broad stock market has been dropping in January and February. But I do think that REITs, once some of the uncertainty in the market sort of calms down a little bit, I think that they're poised to perform well. So I continue to be happy with your REIT exposure at this point in time. And interestingly enough, global REITs are holding up better in January and February than domestic REITs are. It might seem counterintuitive. We'll see what the remainder of the year brings. You're pretty equally weighted between the two, a little bit more weighted in U.S. REITs, and then also you are overweighted in U.S. REITs because probably 50% of the Prudential Global REIT Fund is also in U.S. REITs. So I would, I'm still, quite happy with exposure, but, happy to discuss real assets exposure. It's certainly the asset class of the moment. And if you have any questions or concerns, we can address those.
I'm not seeing any.
Okay. Then I think that what I will do is go to page 8 and start covering asset allocation. So if we go to page 8 of this report, we'll see the asset mix table through year end. And you ended the year overweight U.S. equities because U.S. equities had performed so well. You were equal weight you were equal weight to the target in your real assets. You were underweight in fixed income, both because of weaker performance than the equity markets. That was the primary reason. And your operational cash, you have a 2% target. We've been keeping you at we've been trying to keep you at 2% and a little bit higher. During the periods of heightened volatility, we like to know that you have 6 to 9 months of benefit and expense payments in cash, so that if the markets are particularly volatile any given month or quarter, you're not forced to sell stocks or bonds or real assets to raise cash. And so we had no rebalancing recommendations for January as of year end. With the market pullback, you are still overweight equities at the end of February, but a little bit less so. And what I would ask now is that you turn to the February flash report, and we can sort of discuss asset allocation on a more current basis and any rebalancing recommendations. And the February flash report is on page 88 of this packet. Or you may have a hard copy in front of you at your desk. So if you have that information in front of you, I will let you know that at the end of February, the market value of the Murfreesboro defined benefit plan was $174.5 million. If you might recall, or if that at year end, you had $184.2 million. So between January and February, assets have dropped $10 million. Interestingly enough, the majority of that drop occurred in January. And $7 million of it occurred in January, $3 million of it occurred in February. Of course, the invasion did not start until the end of the month. February was actually shaping up to be a relatively decent month before the invasion, even with the wall of worry we're climbing with interest rates and inflation. That's sort of how activity shaped up from a dollar standpoint. And as I mentioned, despite the heightened volatility caused by the Russia invasion of Ukraine, the plan remains overweight its target, 48 versus 42% in equities. And most of that overweight is in U.S. large cap, mid cap, small cap, and developed markets and your global equity managers. The only equity manager that's underweight its target is emerging markets, not surprisingly. Real assets are 1% underweight target. You're at 22% versus 23%. At year end, you were pretty much right on target, so the pullback real estate accounted for about a 1% drop in the pullback from the target allocation. And fixed income remains underweight, 28.5% versus 34%. Your operational cash was 1.7%, and we recommend sort of rebuilding that back up closer to 2%. So we had minimal rebalancing recommendations. I don't usually like to rebalance when I feel like I'm trying to catch a falling knife. And with both bond and equity markets on the move and very volatile day to day, I kept rebalancing recommendations minimal, trimming the largest overweights you have in both large cap domestic core equities and large cap value. So that's Pinnacle and Brandywine value, trimming them both by $300,000 and putting that $600,000 into the operational cash. So that concludes my comments on performance of the plan. From a performance standpoint through February, I would say the plan, sort of just eyeballing it from looking at the funds that you're invested in, that the plan is probably down about 9%, the total fund. There's only one investment that you have that's in positive territory year to date. That's the Natural Resources Fund, which is up 27%. You have a few funds on the equity side that are playing a pretty good defense, and that would include Brandywine Large Cap Value through March 14th was down 5%. American Small Cap, Century Small Cap Value also down about 5%. Harbor Mid Cap Value down 4%. So a number of your domestic equity managers are significantly outperforming their respective indices. So, but it's still a minus sign. It's just a smaller minus sign.
Okay, well, thank you for all of that information. Certainly very relevant discussion with what's going on across the world right now. So,
and then the last thing I was going to finish up with is the discussion on the transition of the Western Credit Opportunity Bond Fund. Erin, do you think now is a good time to cover that?
Yeah, I think so. Does anybody have any questions on the flash report or any of the information Nataka just covered? Okay, I think we're ready to move into that discussion now, Nataka.
Okay, well, again, I don't know if you have it in hard copy, but on page 90 of the materials that were sent out, there is a discussion of the, starting on page 90 of the Western Credit Opportunity Bond Fund. As Erin knows, and maybe a few others know, in early February, we got notice from Western Asset Management that they were going to be wrapping up the Western Credit Opportunity Bond Fund. It was a special opportunity vehicle that they started in August of 2020 to take advantage of dislocations in the bond market that were brought on by the pandemic. They felt that there were a lot of mispriced bonds and opportunities for rebounds, and they put together a special opportunities fund. You invested, let's see, let me just get my materials out. You invested $8 million in that bond fund in August of 2020, and as of year end, there was $8.9 million in it. The investment did quite well for you. Western is feeling that a lot of the special opportunities are now, really part of more the mainstream market within the high yield and floating rate notes and CLOs and other asset-backed securities, as well as investment-grade securities. So they've decided to wrap up the fund. They are anticipating the wrap-up is going to occur sometime between March 28th and April 28th. And so I've been working with Western and Erin and Jennifer to sort of come up with a transition plan for those assets. Chartwell's recommendation is that the assets be invested in a publicly traded mutual fund that's a multi-sector bond fund. So similar strategy to the Credit Opportunities Fund, but in a public, daily valued format. Western has a fund called the Western Asset Income Fund, and I've attached a fact sheet to this report for you that would be pretty close transition insofar as bond market sectors and exposures. So, that's, we continue to think at Chartwell that the credit and spread product space within fixed income will continue to perform well. So you have a core bond manager in place with Pinnacle. You have TCW also in place, a core bond manager focusing a bit more on mortgages and asset-backed securities. And a multi-sector bond fund would round out and keep your fixed income team diversified. Any questions on, just sort of what's happening with the Credit Opportunity Fund and, any questions about that?
Just one question, Natalka. How would the investment be allocated? One fell swoop or, over a few months? How do you picture that?
The initial transition would be one fell swoop. Western is planning on liquidating about 98% of the Credit Opportunity Fund between March 28th and April 28th, and the remaining 2% will be used to sort of settle out audit fees and whatever other fund closing fees, and then whatever is left they will distribute later in the year. But the vast majority would be one fell swoop. Once it is invested in the, if it gets invested in the Western Asset Income Fund, we have the ability to rebalance and reallocate from there, just as we do with any other fund. So it's sort of nice to have the assets back in the publicly traded world. The Western Credit Opportunity Fund, you only had quarterly liquidity available to you. So this is nice to be back in a, sort of a daily valued world.
All right, so you just take the $900,000 that we've made and just put that entirely into this new fund?
We would take the $8 million. I think now.
Oh, the $8 million. I'm sorry. Yeah.
As of
8.9 million. Yeah. Yep. Gotcha. All right. Good deal. Thanks.
Yes, and as I said, at that point in time, it really becomes the a tool that we can use for rebalancing. So if we decide that we raise more cash, or we decide we want to put more money into, other types of, your other bond managers, we can certainly do that almost from day one after the assets hit the account. Now, one of the things that I will say about the Western Asset Income Fund, it's a multi-sector bond fund. One way that it differs from the Credit Opportunity Fund structure is that virtually all multi-sector bond funds have emerging market bond exposure. And that really hasn't been a problem up until the end of February. Western Asset Income Fund does have emerging markets exposure. If you look at the fact sheet that was attached to the materials, they have 13% invested in emerging market bonds. Of that, 1.5% is in Russian bonds. which have not been defaulted on yet. They're supposed to be making an interest payment today. We'll see. And they may say, yeah, we'll pay you in rubles, and which the world says, okay, that's a default. And they also have 2.1% exposure to the Russian ruble. And as I said, and Chartwell can certainly show you other multi-sector bond funds, all actively managed and index multi-sector bond funds have exposure to emerging markets. When Western put together the Credit Opportunity Fund, it was not a registered mutual fund. It was a special purpose, sort of all. So they sort of said, we're not doing emerging market bonds. But in their publicly traded multi-sector bond funds, they do. So I do want to make you aware of that. Now, I mean, making a future investment in this fund, sort of the pain and the hit that the fund was going to take for Russia exposure has occurred. So going forward, you're sort of starting with like no Russia exposure in this fund. So there is other emerging market bond exposure, clearly, and it's on that fact sheet. So I do want, the committee to be aware of that. It's important for you to understand the underlying investments that, some of your mutual fund managers have. So I don't know if that would change your opinion of what you want to do with the money. As I said, I'm still comfortable with making the initial transition into the multi-sector bond fund, and then take it from there. And we can change the allocation. If you're very uncomfortable with the multi-sector nature of the Western Asset Income Fund, the secondary plan for transitioning these assets would be to send the $9 million or 8 point whatever million dollars into a money market fund, into cash. Because right now I don't know that I'm 100% comfortable saying, yeah, let's put it into TCW or Pinnacle. Either. So there aren't a tremendous amount of really good choices.
Natalka?
Yes.
Was not this Western Bond Fund our initial attempt to sort of get money in a bit more of a private position, or not?
When we went into the Western, the Credit Opportunity Fund, we had to select a private vehicle because that was all that was being offered. Over the years, we have discussed private investments for the defined benefit plan, both private real estate, potentially private equity, and/or private debt. Right now, to date, the committee has been more comfortable using public market surrogates like the REIT funds as opposed to direct private real estate.
But our purpose was to give us that particular, in my opinion, more aggressive money, better opportunity as opposed to just a public fund.
That's correct.
So here we are moving back to a public fund.
Yes.
And it'll be just like any of our other mutual funds.
Yes.
Okay. Do we not need to raise our cash position a little bit according to your allocation anyway?
Yes. And yes, we'd like to keep your cash between 2 and 3%.
I don't know the percentage that $9 million would do that. But that would also give us time to consider something else if we chose to, without having just to throw it into a public fund we don't know a whole lot about. I didn't get, was this mailed to us or what? I didn't get this information about the fund, so.
Did you lay this out for Earl?
I haven't seen that, so I don't know what that fund has done or anything. But it seems to me, yeah, I didn't see that.
Did you email it out prior is what he's asking?
Oh, if it was emailed, that could be me then. Pardon me. Okay, that's just my thoughts about it.
Right.
Okay.
I was looking to, as I said, at Chartwell, we still think that multi-sector bond exposure is good positioning, and we were looking for a fund that was similar to the Western Credit Opportunity Fund to maintain that kind of exposure that you had anyway. And there are other multi-sector bond funds that we're very familiar with at Chartwell. Our clients work with a number of different multi-sector bond funds. I thought to facilitate a smooth transition, a good first landing spot would be the Western Asset Income Fund, because at Western Asset, that's what's sort of considered the public version of what the private Credit Opportunities Bond Fund was. And then, once it's in a publicly traded, daily valued fund, we could rebalance from there. So that was my initial thoughts with the transition planning. And so, very happy to present the committee with other multi-sector bond funds and such. It just, for the redemption of the Western Credit Opportunities Fund and then getting the money back into a public format, I just felt, and in speaking with both Western and Pinnacle, your custodian, that transition would go rather smoothly if it went into the Western Fund. And then we could move it around from there. But,
At the same time, the Fed's about to embark on raising interest rates here. I don't care what bond fund you're in, that's not going to help them. And secondly, there will be some fees involved that if we were sitting in cash, we probably wouldn't be paying. My thoughts, that's all.
Okay, well, I would say, and that's fine. I think the committee needs to, make a decision. As I said, the redemption with Western Credit Opportunities is going to occur sometime between March 28th and April 28th. And, from your standpoint, it would be good to have an account opened to receive the redeemed assets I would say by March 20th, so that whenever Western's ready to wire money, they know where to wire it to. So we just sort of need to let Pinnacle know whether it's going to go into a money market fund or whether it's going to go into, another sector bond fund.
Okay. So we need some motions.
We need a motion, yes. I was thinking about what Mr. Hull was saying, with regards to the, whether or not to keep it private. Is it also, Nataka, an option for you to come back at our next meeting with maybe some other private fund options? In the meantime, either go, into this the public Western Credit Fund or into the money market, and then we can reevaluate a private a little bit further down the road. I think the main point here is that we're under a bit of a time constraint because the fund is about to close any day.
I don't want to give the impression I'm for private investment in this fund, because I'm not.
Okay.
But that's why we moved it in the first place, I thought. Yeah, okay.
I hate to see us put $9 million almost in cash.
Right, that's my concern.
We just did the
I'm-
rebalancing too,
Right.
based on the recommendations from Natalka from last week. So we've increased our cash at this point.
Personally, I'm comfortable with Natalka's recommendation about moving it to the Western Asset Income Fund, and as well as the rebalancing on our existing portfolio with taking the cash out of the large equities.
Right. Which that was done yesterday, I believe.
That was done yesterday? Okay.
Yeah.
All right.
Okay.
And Mr. Hurl's right, that was our initial reasoning for making this investment.
And
I think we can still circle back to that.
And
Right.
speaking of private investment, you still have this private equity fund that we haven't funded yet, correct?
We haven't funded.
So
Right.
that's our,
It's a
that's a
potential.
vehicle for private
Yes.
funding if we decided we want to pursue that.
Right.
And so,
Unfortunately, but yeah.
so, I don't know.
Well, and it depended on what our opportunities are.
Right,
Whether or
right.
not we will continue
Yeah.
with that. But it was something on the table for us
Yeah.
to consider.
So do we want to make a motion to accept Natalka's recommendation?
That's my motion, yes.
I'll second that.
Okay, all those in favor?
Aye.
Any opposed? Okay, motion passes. Is there any other business to come for the committee? Natalka, thank you so much for getting in front of that and keeping us informed of those changes and working with Jennifer and me and with Pinnacle to try to get this transition done as smoothly and quickly as possible. Is there any other business to come for the committee? Nope. Okay, seeing none, we can adjourn the meeting. Thank you.
Thank you, Erin.
Thank you, everyone.
Thank you.
Talker.
Bye-bye.
Bye.